Good day, everyone. Hi, my name is Carly B. Andaya. I am the leader of Group 1 from ABM 12B, and this is our performance stats for our subject FABM2. So, let me introduce to you my members: Corañas Kathleen, Cruzado Avi Grace, Loretta Jessie, Rubio Jel, Sierva Argeline, and Diaz Lizelle. So we'll be discussing today the Module 5, the components and structure of the cash flow statement. Introduction to the lesson. So, what is cash flow statement? Cash flow statement, CFS, also known as a statement of cash flows, is a formal statement that provides information about the cash receipts, inflows, and the cash payments, outflows of an entity from the operating, investing, and financing activities during this period. So, unlike the Statement of Comprehensive Income, the CFS only shows the cash transactions. It is prepared based on the information from the income statement and the balance sheet. So, in short, it portrays how a company gains and spends its cash. The introduction to the three major parts of a cash flow statement. The CFS have three major parts: the operating, investing, and financing activities. So the three major parts of CFS, the first one, operating activities. Activities of an entity related to their main revenue generating activities of providing goods and services. Where to see in FS usually? It is usually found in income statement, balance sheet, current assets, and current liabilities. In investing activities, activities of an entity related to a sale purchase of a long-term assets and other investment. Where to see in FS usually? This is usually found in balance sheet, non-current assets. Financing activities. Activities of an entity related to acquisition of funding of the use of entity. Where to see in FS usually? It is usually found in balance sheet, non-current liabilities, and equity. So, let us know the three major parts more deeper.
Hi, I'm Kathleen. Operating activities involve the production or purchase of merchandise and the sale of goods or services to customers, including expenditures related to administering the business. Also, it generates the majority of the cash flows from the company as it is directly linked to the core business activities of the companies like sales, distribution, and production. Operating activities are all the things a company does to bring its products and services to market on an ongoing basis. Cash flows from operating activities is a section of a company's cash flow statement that explains the sources and uses of cash from ongoing regular business activities in a given period. This typically includes net income from the income statement, adjustment to net income, and changes in working capital. Cash inflow refers to what comes in and cash outflow is what goes out. This includes cash payment from customers, cost of goods sold, administrative expenses, and marketing. Cash outflow and cash inflow includes debt and dividend payments, company share, and small business loans, among others. Cash inflow describes all of the income that is brought to your business through its activities, while cash outflow includes any debts, liabilities, and operating costs.
Hi, my name is Avi Grace Cruzado. I'll be discussing investing activities. So, investing activities refers to the purchase and sale of long-term assets and other business investments within a specific reporting period. Investing activities is all about non-current assets, which include property, plant, and equipment, as well as intangible assets. Cash flow from investing activities involves long-term uses of cash. When you sell things like property, plant, and equipment, and you get cash from selling that, which is referred to as cash inflow. But if you sell inventory and receive cash from selling inventory, that is not an investing activity. That is an operating activities because your main revenue generating activity is selling your inventory. And what we are talking about here are productive assets other than inventory. So in cash outflows in investing activities is If we acquire new investment activities in equity securities or purchase property, plant and equipment, we'll take money out and those are cash outflows from investments. Also keep in mind that it usually has an impact on the balance sheet non-current assets.
Hello, my name is Jesse Lorete. The topic that I discussed today is the financing activities. Financing activities is related to non-current liabilities. Take note, non-current liabilities. Ibig sabihin yung mga long-term debts siya. Sa financing activities, meron dalawang classification. Cash inflows and cash outflows. Ibig sabihin sa cash inflows, yung cash na pumapasok sa isang company. Sa cash outflows, yung cash na pumapasok na lumalabas rather sa company. Sa cash inflows, nandun yung mga pwedeng yung mga nanggagaling na utang galing sa mga shareholders or investment ng mga shareholders. Pasok siya sa cash inflows. Cash outflows, ibig sabihin naman yung mga lumalabas. Yun yung, di ba, nangutang sa cash inflows. Ang gagawin naman sa cash outflows, syempre, babayaran yung long-term debts. Long-term kasi non-current liabilities nga. Kaya maglalabas siya ng pera. Pasok siya sa cash outflows. Tapos, ang pinagkaiba ng financing activities sa operating activities. Financing activities, ibig sabihin, yung principal cash yung binabayaran. And sa operating is yung related activities. Ayun yung pinagkaiba nila. Principal, ibig sabihin, financing activities. Tapos related activities, ibig sabihin, operating activities.
So, again, this is the three major parts of CFS. So, let us now go to the direct and indirect approach of CFS. Cash flows from operating activities can be presented using either direct or indirect method. So, let's know their difference.
Hi guys, good morning, especially to our beloved teacher, Mrs. Vargas. This is Jellyfit Tulabing Rubio, grade 12 student of Horacio de la Costa. If the entity net cash used in operating activities is obtained by adding individual operating cash inflows and then subtracting the individual operating cash outflows, then the method used by the entity is direct method. Note that the method used in this example is direct method. Net exchange in cash or net cash flows increase or decrease. Is the net amount of change because either it is an increase or decrease for the investing and financing activities. Beginning balance is the balance of the cash account of the beginning of the accounting period. Ending balance is the balance of the cash account on the end of the accounting period. Compute using the beginning balance plus the net change in the cash for the current period. Cash flow statement should only include cash transaction and the net income or loss of the company including non-cash transactions, such as depreciation, changes in current asset, and the liabilities are included if they are related to revenues and expenses, which were included in the net income or loss even if they were non-cash transactions, or they affected cash but were not a part of the net income, lost or lost, accrual, prepared or unearned.
Net cash provided by operating activities was not resulting from cash transaction but by adjusting profit for income and expenses items. Then the method used by the entity is indirect method. What is the cash flow statement indirect method? The indirect method for the preparation of the statement of cash flow involved the adjustment of net income with changes in balance sheet account to arrive at the amount of cash generated by operating activities. The statement of the cash flow is one of the components of a company's set of financial statement and is used to reveal the source and use of cash by a business. It presents information about cash generated from operation and effects of various changes in the balance sheet of a company cash position. The format of the indirect method appears in the following example.
In the presentation format, cash flow are divided into following general classification. Cash flow from operating activities, cash flows from investing activities, cash flows from financing activities. The direct method of presentation is very popular because the information required for it is relatively easily assembled from the accounts that a business normally maintains in its charts of the account. The indirect method is less favored by the standard setting bodies since it does not give a clear view of how cash flows drove a business. The alternative reporting method is the direct method.
So I hope you learned something from us today. Again, I am Carly B. Andaya, the leader of Group 1 from ABM 12B, ending this lesson with the famous saying, never assume unless otherwise stated. Happy learnings, guys! Thank you for watching!